Okay, guys. This is the stock market, chapter 11, section 3. Yeah, here we go. So this, you all should know what this is by now because you've kind of been doing stocks for forever. But this is Yahoo Finance. And the stock that is showing right here is Microsoft. Plumber bought Microsoft a long time ago and made a lot of money. Okay, so let's start with the basics of stocks and then we'll get into all this stuff. Okay, so we're talking about buying stocks because that's the first section in your textbook. Besides bonds, corporations can raise funds by issuing stock, which represents ownership of part of the corporation. Stock is issued in portions known as shares. By selling shares of stock, corporations raise money to start, run, and expand their business. The book lists 2 benefits of buying stock. 1, dividends. When you own shares of the stock, most, if not all, corporations and companies will pay you dividends. So, what are dividends? Dividends are the part of the profits that you own as a stockholder. So if you own 1% of Microsoft, you get 1% of their profits. That's a lot of money. That's what dividend is. Plumber, you own a certain amount of shares in Microsoft. How much was your last dividend?
Oh, $60-some.
And how many shares do you own?
80-some.
How often do you get that dividend?
Quarterly.
So yeah, he owns 80, you sold it, right?
I did, I sold a lot of it.
He owned 80 shares of Microsoft.
It was a lot.
And every quarter, every 3 months, because that's a quarter of a year, every 3 months they pay him $60. That's what dividend is. You make money just by owning shares in a company. The other one that the book lists is capital gains. Capital gains are when you buy a stock and then you sell a stock. Okay? Yeah. A capital gain specifically, there are 2 types, capital gain and capital loss. Capital gain is when you buy it and then you sell it for more. A capital loss is when you buy it and then sell it for less than you paid for it. Kind of obvious. Obviously, if you bought Microsoft right there and you sold it up in this area right here, you're obviously making a capital gain. If you sold it today and you bought it 4 years ago, you're making a lot of money. But see how up this area comes to a point and it drops down a little bit? If you bought it at that top point and then sold it now, you'd be having a capital loss because you'd be losing money. Okay, there are 4 types of stock that the book mentions. Income stock is one of them. By paying dividends, this stock provides investors with income. Income stock, you get income. Growth stock. This stock pays few to no dividends. Instead, the issuing company reinvests its earning in its business. The business and its stock thus grows value over time. If you want to make money in a growth stock, you don't get dividends. So what you need to do is you need to buy it and then sell it later. That's how you make money with the growth stock. Because they put all the money they make from stocks back in the business and don't pay dividends. And then that brings up the value of the stocks, you can sell it for more. Stock is also classified as to whether or not the stockholders have a vote on company policy. Plumber, is it common for stockholders to have a vote on company policy?
Yes. So your stockbroker should be engaged with you in terms of when they're like going to vote on board members, cut dividends, why they're cutting, do you agree or disagree? It's just like yes, no questions pretty much. Do you agree with board? It's like, it'll have like board recommendation, and then you can either agree with the board or disagree with the board.
Okay, so you still get a say with most companies, right? Okay, common stock investors who buy this stock are usually voting owners of the company. They usually receive one vote for each share of stock you own, so that's what Plum was just talking about. So basically, if you own a lot of the stock, more than half of the stock, your vote matters a lot more than people who barely own any of the stock. Preferred stock, investors who buy preferred stocks are usually non-voting owners of the company. Owners of preferred stock receive dividends before the owners of the common stock. So they get dividends first in exchange for not being able to vote on company policy. Whew. Okay, and the last thing it says, if a company goes out of business, preferred stockholders get their investments back before common stockholders. So that's some benefits for being preferred. Bad thing about it is you don't get a vote. Stock splits is the next thing. So a stock split is the division of each single share of a company's stock into more than one share. So owners of common stock sometimes vote on whether to initiate a stock split. A company may seek to split a stock when the price of stock becomes so high that it discourages potential investors from buying it. So for example, Microsoft's sitting at like $111, $112. But so if their stock jumped up really quick to like $300, people would be risky of buying it because they're like, it's just probably going to go back down. That's really expensive for Microsoft. So what the company does is they split each stock into multiple different shares of stock to bring the price back down, basically. Okay, the risks of buying stock. Obviously, the main risk, you buy a stock and then it loses value, and then you sell it for less than you paid and you lose money. No one wants to do that. So, basically, if you want to buy in the stock market, you really want to do your research. Make sure your company that you're wanting to buy from is trending up. Making sure that you're going to make some money at least, or at least not lose a ton of money. It's always good. How stocks are traded. So as Plummer just said the word stockbroker like 5 minutes ago. I bet most of you were probably scared by that word and had no idea what it meant. The stockbroker is a person, because you can't buy stocks yourself really. So a stockbroker is a person who links buyers and sellers of stock. So you get a stockbroker and they go to people selling stock and you're like, yo, what up? My client wants to buy your stock. And then they say, sure, I'll sell it, or no, I don't want to sell it. And then you buy it or you don't buy it, all that good stuff. That's what a stockbroker is. Stockbrokers work for brokerage firms. Those are businesses that specialize in trading stocks, obviously. Brokerage firms earn a profit by charging a commission, and if you don't know what that means, it's basically a fee on each stock transaction. So basically, if you buy stock from someone else, the stockbroker gets part of the money. Stock exchanges. Market for buying and selling stock is known as stock exchange. Yeah. Yahoo Finance runs with the New York Stock Exchange mostly, otherwise known as the NYSE. That's That's going to be what we're really talking about. And the New York Stock Exchange, obviously, is in New York. Okay? It's not in Boston, it's in New York. Like, you know that one scene in The Dark Knight Rises where Bane goes in that one place with all the people with the fancy suits and steals all the money? That was the New York Stock Exchange. So the New York Stock Exchange is big and handles basically all of the U.S. top companies and basically a lot of top companies around the world. There's also this thing called the NASDAQ. Yeah. Okay, there are these things called over-the-counter stocks, and those things are really, 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 really risky. And the NASDAQ was created to help organize the over-the-counter stock market through the use of automation. NASDAQ is the second largest securities market in the country and the largest electronic market for stocks. By the way, the other one, Plummer has probably mentioned it, is called the Dow Jones, that thing. Futures and options. Futures are contracts to buy or sell commodities at a particular date in the future at a price specified today. So, with the future, if you had corn, because we live in corn, that's all we have ever. If you have corn, and you have, we'll just say 1,000 tons of corn. I don't know how much corn costs, but let's say you're selling each ton of corn and you agreed to do it, to sell it today. You agreed to sell it for $10,000 per ton of corn. I have no idea how much corn actually costs. That's a random number. So, with the future, you agreed to sell it today, but the actual selling of it doesn't happen until a lot later. So, you agreed to sell it for $10,000 now, but wait, the price of corn shoots up in between when you agree to the future and when you're actually going to be selling the corn. And now you could have got 20,000 for each ton of corn. Again, random numbers. But guess what? That sucks for you. You agreed to the future. You cannot change the price now. This thing called an option. Options are contracts that give investors the right to buy or sell stock and other financial assets at a particular price until a specified future date. Yeah. So, an option. You say, I want to buy your stock. I want to buy it for $100. You're going to give me a year, and through that whole year, I can buy your stock for $100. Doesn't matter if your actual stock price has gone up to $120. I can still buy it for $100 as we agreed to this option. The type of option is called a call option. It's a contract for buying stock at a particular price until a specified future date. That's what I just talked about. That's a call option. This thing called a put option. Contract for selling the stock at a what even? That's the exact same definition. So no, put option is selling stock, not buying stock. So with a call option, you are the one buying stock at a specified future date for the same price. Put option, you're saying, I'm going to sell you this stock for $100 for a year, and that's the price. Doesn't matter if the actual price goes down to like $80, I'm still selling it to you for $100. That's put option. Oh, here they talk about the Dow Jones. In the book it says, when people say the stock market rose today, they're often referring to the Dow Jones Industrial Average. This is a measure of stock performance, mostly known simply as the Dow. Plummer would call it the Dow all the time. The Dow is an average value of a particular set of stocks It is reported as a certain number of points. For example, on a good day, the Dow might rise 60 points, and guess what? As of today, which is December 5th, 2018, I think. Yeah, it's December 5th. As of today, December 5th, the Dow dropped 799 points yesterday. That's bad. That's losing a lot of points. The group of stocks listed on the Dow is intended to represent the market as a whole. To make sure it does, some of the stocks are periodically dropped and others added. Today, those stocks represent 30 large companies in various industries, such as food, entertainment, and technology. There's this other one called the S&P 500 that stands for Standard & Poor's 500. It gives a broader picture of stock performance on the Dow. Tracks the price change of 500 different stocks. Ooh. The S&P 500 reports mainly on stocks listed in the New York Stock Exchange, but some of its stocks are traded on the NASDAQ market. There are these things called bull markets. We've been in a bull market lately. Bull market is a steady rise in the stock market over a period of time. Look at this. See, it's going up. It's a bull market. A bear market is a steady drop or a stagnation in the stock market over a period of time. That would be if it starts up here and goes. You don't want that, you lose a lot of money. Here we are talking about the Great Crash. It's also known as Black Tuesday, right? Black Tuesday. The beginning of the Great Depression. Yeah, the economy was totally booming and all that stuff. Like, totally booming. There was widespread optimism. Yeah, a relatively small number of companies helped the nation's wealth, while farmers and workers were suffering financially. And then we had the biggest crash, not the biggest crash, a huge crash. And it was because of this thing called speculation, the practice of making high-risk investments with borrowed money in hopes of getting a big return. So you borrowed money from banks or from other people, and you made risky investments, and then you either got a return or you didn't get a return. Most of the time they didn't get a return and lost a lot of money. On September 3rd, 1929, the Dow had reached an all-time high of 381 points. By the way, guys, the Dow is sitting at about 26,000 points right now. So, really, really, really big difference. But in 1929, all-time high of 381 points. After their peak in September, stock prices began to fall. Some brokers demanded repayment of loans. When the stock market closed on Wednesday, October 23rd, 1929, the Dow had dropped 21 points in an hour. That's not good. The next day, worried investors began to sell and stock prices fell further. Although business and political leaders told the public not to worry about their losses, widespread panic began. By Monday, October 29th, shares of stock were dropping in value to a fraction of what people had paid for them. A lot of money was going on, being lost, bad stuff. On October 29, 1929, a day known as Black Tuesday, a record of 16.4 million shares were sold, compared to the average 4 to 8 million shares per day earlier in the year. The Great Crash had begun. This is known as the Great Depression. Okay. In October 2006, the Dow passed the 11,700 point mark, reached 14,000 in 2007. The investors realized full extent of the subprime mortgage crisis. I talked about that earlier in my last section. The stock market began to nosedive. By the end of 2008, it had plunged back to the 8,000 range the Dow had, which is not great for us. So people lost a lot of money, and Obama did some stuff, and now it's okay now. Okay, so we're gonna talk about this Yahoo Finance thing. This isn't in the book. These are things that you should probably know about the stock market. So, this is Microsoft. Can't see it because it's hidden by this thing at the top. This is Microsoft's stock over all time. No, 5 years. Okay, so what does this thing mean? Previous close. If I get any of these wrong, Plumber, you correct them. Previous close, that means when the market closed yesterday, that's how much money the stock was selling for. That's what it was at. Open is how much money the stock market
Why don't we-
opened at.